Hey, welcome everybody. It's time for another episode of the GMU Extra Sun Shower series. In this episode, we're going to go over the 3-bar break. Now, we got a really special treat today. We've got one of the candlestick experts out there. We've got a special guest, Jason Thompson, and he is with tickermonkey.com. Welcome, Jason.
Hey, how are you?
Doing really well, and I think I'm pleased to have you on because you're really an expert at these candle combinations, and we're going to get really into the 3-bar break today. So let's get after it.
All right.
So let me break down just what the general concept is for the viewers. The 3-bar break is when you get a range expansion down. It's kind of like a reversal bar. What's important about it, though, it's representing a sharp break. And it's important that the low of the bar closes. And what it's doing, it's taking out all the lows of the previous candle lows. 1, 2, 3. So this one wide range candle is breaking all of those lows. And it closes, below the low of all those bars. If you looked at it on a bar chart, it would look like this. But the concept here is, this is a 3-bar break down. This is a serious kind of caution sign. At a minimum, this is kind of showing you that the momentum of the stock could be slowing down, or maybe it's really signaling potentially a top. So you really want to pay attention to these on your charts. You want to consider either selling a portion, maybe you need to scale down a little bit, because there could be some further weakness. Now, we will talk about things that negate a 3-bar break as we talk on the charts. We'll look at some examples. But the close is also important. And we're going to look at ways that the 3-bar break can help us with our expectations. So what better way to do this is to really get into something current in the market. So this is the Qs. This is really from December when we had this news event through the current day. So JT, take us through what's going on with the Qs and how it relates to this concept of the 3-bar break.
Well, this was the FOMC meeting, and things were okay until the press conference started, and really everything started to reverse hard. So you're looking at this 3-bar break day after we just made an all-time high. So it's really important when you have one of these that happens after something makes a high. It is almost indicative that it's going to base if it cannot recover quickly. And so what we do with this, since this one wasn't a gapping situation, all you do is you take the high and the low of this range. So in this case, you're taking 536.88, the high, you're adding it to the low at 515.01, you're dividing by 2, and you're coming up with this number, 525.95. Now that is the midpoint of that 3-bar break. That's the level that you want to recover at a minimum to reestablish that you're not having some form of a trend reversal going on. So you can see here how the Qs, they did rally back up a little bit into, did we have a half day on Christmas Eve? I believe we did.
Yeah, it's a half day, I think.
Yeah, we did. So that was like a half day session, and then you poke back up through the day after Christmas. Well, okay, so the thing with this midpoint is you will have instances where you reclaim it. You still need to be cautious. You want to make sure you start living above that again. And you can see we lost it into the end of the year. And now here we are again, starting the new year right off the 50-day. And then we rally right up into this midpoint again, push through it a little bit, but then close down on the 6th. And then the next day, on the 7th of January, we have this failed wick setup right up against that line. I mean, the high that day was 525.99. It doesn't get much closer than that. So yeah, and then it's just started to go down. I see you got 525.59 over there, but it's 90, yeah, 95 anyway. Yeah, and so here we are right now. So the thing is, we're on day 2 of a rally attempt right now. We haven't corrected 10%. So you really don't need a follow through day. But in this case, you can see how that 3 bar break has led to a 3 waves down situation on this chart right now. So it may still be a little too early. We'll have to see what goes on with this, but you can just see how important that midpoint is.
Yeah,
So
it's a great example of just how, how do you use this bar? Well, this helps you start to frame your expectations of what could become resistance, how you might want to be a little cautious unless you see some strong progress through the midpoint. Let's look at some other examples here. This is actually going back to the summer of 2023. This is Coinbase. So you're probably all familiar with this, very strong stock, but it goes on streaks. It goes very strong for a while, then it has some pretty sharp corrections. So you can see here, again, as Jason mentioned, right off the top, all-time highs, we get a reversal candle, and then it kind of stalls in here a little bit. And then you can see this bar here is the 3 bar break, taking out these lows. Now, one of the ways that I use it, I'm looking at this candle, looking at the midpoint, a simple concept is, if you can recover, for me, if you can recover at least 50% of the candle within 2 to 3 days, that to me, excuse me, is a sign that maybe things aren't as bad. You still want to be cautious, but you'll notice here, excuse me, you'll notice here that the stock continued to be weak. We didn't even rally up into the line. We got some more weakness. We had a reversal here. So it's been weak. And then what really is noteworthy is before we even made a serious rally attempt, we got hit with another 3 bar break, taking out all of the lows of these candles. So now your antenna is really, really open to, hey, this stock is really under distribution. You can see the volume picked up a little bit, and you say this is not a good sign at all. So that's, one of the ways you're trying to see, is there going to be a recovery? Sometimes you get it, sometimes you don't. But that's one of the ways that this is really telling us that there's something more significant going on, and you can see how the stock corrected quite a bit from that point. Now, Jason, a little bit on the reversal here. Why don't you take a look at, can you describe a little bit how you would use the 3 bar break to the upside?
yeah, that's the thing. And going what you were saying there, when you can start to get them back to back like that, as something's coming down, that's really ominous, and you do have to back off. And it's the same after something declines for a long time. You may have range compression that happens, and then you get a 3 bar break to the upside. That's your first inkling that the downside, it may be shifting directions again. It may have found the support, the buyers, that's the price they want, and they wanted it so aggressively that day, it causes it to range expand up. There could have been news that day, other things, but you take note of those days, you take note of the close that day, and you can do the same process on 3 bar breaks to the upside. Take the midpoint of them, because usually you will have a few days that start to come back and it pulls back. Now you can see here, just eyeballing that, it did pull back under the midpoint of that first 3 bar break to the upside, but keeping that in mind, it started to take it out again. So, you'll have 3 bar breaks that you might have, ascending price action where it breaks it to the downside. You may have um, descending price action where it breaks it to the upside. And then sometimes you'll have this horizontal sideways action. So you can kind of see the first 3 bar break to the upside, John's noting here, that was from descending price. It took it out to the upside. The next one, you get this gentle float back, and the 3 days that it's taken out here were kind of horizontal, but you're still getting the same results. You've got your 3 bar break. You're going to take note of that close, and you're going to take note of that midpoint of that bar. And so you've got multiple levels you're dealing with. The midpoint of the first 3 bar break bar, the midpoint of this one, the closes from each of those. And now the next day you can kind of see there, it didn't really pull back that much the next day. And then the resulting action on this, I believe Coinbase went on a decent run after that, if I recall.
Yeah, I think it was a little bit mixed. It got going, but I don't think it went too far.
Yeah, a little choppy.
A little choppy, I think. Yeah, let's look at another one. This is actually Uber from the same time period. This is July, August of 2023. And just to put it in context, the NASDAQ composite actually peaked. I think it was the third week of July in 2023. So it's important sometimes when you're looking at a chart with three bar breaks or any chart really, you want to correlate it a little bit with what's going on in the general market. Is your stock acting stronger than the general market, or is it acting weaker than the general market? Now, we put this chart in the deck because we wanted to show you not only did it have some three bar breaks to the upside, you can see one here, and then we also have another one here. And you can see that these kind of are ascending. We never came back down and tested the lows. So that's good. It was in an uptrend. The stock was trending, doing well. But eventually, as the market peaked out, you can see this is a bad bar in the sense that it's a high volume bar. There's something associated with earnings probably that day and news. So there's a lot of things going on. But we wanted to point out that this is not actually a three bar break. You'll notice that this close is above the low of this bar. So officially, it's not a three bar break, but there's no doubt it's a bad day and the market is peaking at this point as well. And the point being, on a wide range bar like that, you still want to pay attention because it could be enough to really slow the momentum of the stock. And you can see here, this started to drift down fairly controlled way. It wasn't a big, massive sell-off, but it came down and it had needed time. And it ended up forming a cup with handle that eventually had to move higher in the fall of 2023, I believe. But Jason, how important is that close on the three bar break?
It's important. I used to make mistakes with this when I was first practicing with it because I used to consider that to be the three bar break, and then sometimes they would take right back off and continue to the upside. So the mistake I was making was while that was a three bar break intraday, when it was on the low of the day that day, it was, but it didn't close that way. So how it closes is very important. Now, even with that though, this was a gapping situation. So it was earnings related. It was gapping down. So again, on these types of gaps, you take the close from the prior day and take that close and add it to the low and divide by two. And that's kind of how you get your midpoint on that. And you can kind of see a couple of days after that three bar, well, this spirit of the three bar break here on Uber, you can see that rejection candle with a lot of wick on the upside right there. That was probably that midpoint area coming
Right.
into play. And it's not the end of the world when you get a three bar break. It is just a correction in the trend. It's a reversal. And in the case of Uber here, it was the left side of a new base. So
Exactly.
a lot of times, if you go and study bases, I guarantee you you're going to find bars like that on the left side of the base.
Right.
So
It's very, very common that the left side, the momentum stops and we start to decline. Correct.
and also when you start to look at the bottoms of bases, you will start to find three bar breaks to the upside along the lows of a base. Now, I really, you know, there's some spirit there with a few, but they're not nothing super textbook there. There's one right there. Yeah. So you start to get that, and then you're like, okay, this thing's starting to turn back around. Now, even with it making this handle and stuff, see where it was making that handle? That handle was made, that midpoint on that handle, the handle pivot was below the midpoint of the bad break on the left side. So it still required some work. And then, of course, look right here as it's coming out of the handle, John. Yeah, go back. That bar right there. Yep, that's a three bar break to the upside. It was
Right.
actually a wick setup that then went on a three bar break. So when you start to build the new base, you start to have them on the upside coming out. It's just take notice that it's changing back. So
Character change.
yes.
All right, this is a good one. This is AppLovin. So this is a stock that's probably on a lot of people's minds. It was a very big winner in 2024. Why don't you take us through this one? Because there's, this idea of how do we calculate midpoints with a gap down?
Yeah, and it's a similar concept. If any of you have done the courses talking about pink rally days, and you'll have gaps involved, so you have to figure out your range with the gap included. And AppLovin is an example of that. On 12/6, that was a Friday, it was going in, and it was highly anticipated it was going to get added to the S&P 500. It did not, so it gapped down in the after hours, and it followed through that Monday on the 9th. Now, the way you want to get the range on this one is you want to take the close from the 6th of December 2024, that was 401.50, and the low, you're going to add that to the low on December 9th, 2024. The low there was 332.35. Divide by 2, and that gives you this 366.93 midpoint. So you can kind of see how it really hasn't even come into play at all. And that's just a sign of, kind of stay away from this thing. It's come down, it's plotted along the 21 EMA. It has just now recently got into the 50-day. When did you cut this chart? Anyway, that looks like on the 13th. So you also want to then just take the midpoint of the day itself, the range. So you're going to take the midpoint from the 9th all by itself. So the high there was 379.90, the low 332.35, divide by 2. And that's going to give you this 356.13 midpoint. Now you can see that did come into play recently on the 6th of January. Got up there, got through it intraday, but then closed below it, and you can kind of see the next day, then it just gaps down. So if anything, this just kind of keeps you out of the way of getting chopped up. If you're one of those traders that can dance between the raindrops and try to probe along the potential bottom of a new base, go ahead, but the majority of people should probably just avoid the paper cuts, back off, let it do its thing, and see if it can round back up the right side and get above these midpoints.
Yeah,
So,
this is excellent because what this really is showing is detailed chart reading. This is really looking, and Bill would actually recommend, bar by bar, what's happening. So, we encourage you to really go look at your charts, look for 3-bar breaks, and then watch what happens, as it unfolds, and follow it through to see if it recovers or does it chop around and it's getting resistant at certain levels. And then maybe you're looking for 3-bar breaks to the upside to say, okay, maybe we've reached an equilibrium of buyers and sellers, and it's turning back a little bit more to the buying side. So it's detailed chart reading that can help you. Really, the point is this can help you frame a trade, knowing some of these levels that aren't obvious to many people using technical analysis.
and that's the thing. Like, if you look at this chart a little bit more in detail, if you mouse over the 16th of December there, yeah, that was a 3-bar break to the upside. So, and it was right off the 21 EMA. So you get this little inkling of, ooh, can this thing recover? And then 2 days later on the 18th, 3-bar breakdown. So you've got this battling back and forth that's going on, like that little right to the right of that blue, that combo to the right, the little wicky red candle right there. That was a 3-bar break to the upside. So you get this little inkling again, but it can't get going, and you can't get above the midpoint of the really bad break. And again, this has occurred off a high after something has run up plus 700 something percent in 2024, I think it was. So, again, recency bias makes people want to stick to things that, may be a little mature in their run and may need more time, like months, 3 months, 4 months, 6 months. It may not be dead. It just may have to digest for a long time.
Right. Exactly. Keep your eye on it.
Mhm.
All right. So let's I've called up Twilio here, and this is from December. Another, we've been talking about three bar breaks, but I wanted to put something in the deck here that is just a bad day, a really bad break in a stock. So this is a case, again, this happens to be the news day on December 18th, where Twilio had been really performing very well. Relative strength line was very strong, and everything got dragged down sharply. So, when that happens, I have a general rule that I use. It's kind of called the bad break recovery rule. And when I see this, a stock down 3.9%, this is the first time it's come down. It closed below the 20. I'm paying attention. And my rule is really simple. It just says, I want to see if the stock can recover 50%, that 50% midpoint line in 1 to 3 days. If it can, to me, that's a really a positive sign. And you can see here, 1, 2, 3 days, Twilio has gotten, not only has it recovered from 2 to 3 days below the 20 EMA, which is a really good sign in leading stocks, but you can see we're probably in the upper, quartile of this range now. So that's a very good sign that the stock, to me, that says maybe this was, it was washed down in a bigger, broader move of the market, but still the stock still has some strong characteristics. Now, if it can't recover in 3 days, at least 50% of the bar, I think that's really ominous, particularly as the context that Jason mentioned. When you're coming off a fresh new high and you get hit, usually a leader gets hit and it comes back really strong and quickly. Now, Twilio has not rocketed to new highs because we're going through a choppy market that actually is correcting. We looked at the Qs earlier and it's correcting. If anything, you can see Twilio is acting pretty well across this chart. And it looks like it's forming a consolidation. So I think it's still got some good relative strength here. We're very close to new highs. But that's a simple rule you can use that's regardless of a three-bar break. It's just looking at bad days in the market to say, what's the X-ray into my stock? Is it still a healthy leader, or is it really, really in trouble?
Yeah, and do you have cushion? That's the other thing. If the market's in trouble too, and you're having this stuff go on in a stock that you own, and you don't have a lot of cushion, and the market's starting to come off 5% off its high, 10%, the stock you're holding, if it's a growth stock, is probably going to be coming off 2 to 3 times as much as the market. And if you don't have the cushion, you're better off scaling down and letting it set up, and you've got profits to operate on when and if you come back into that name. So, that is why this got burned into my brain so much, was because I had some names where I was up 100+% on them, and I didn't really care. Oh, bad break, whatever. I can absorb it. I've got cushion. Well, if you've got 100% gain on something and it corrects 40%, congratulations, you now have a 20% gain. So you give back a ton. That's how it got burned into my brain, because I had situations like that where I was so cocky because I had such a big cushion that, you know, these things can come off 20, 30, 40%. And that's can still be normal for that stock, but
Right.
can you withstand it? That's the
Yeah.
thing.
Yeah. The other thing that's important right now while we're talking about it is, I know with Rain King Insights members, we've been talking about this, looking at relative strength. And this is subtle, but you can see with the low of the washdown, this low right here, you can see is above this low. So in the market, I don't know the exact date on the 13th, but the market made a second wave down and a third wave down. And you're looking at stocks to say which ones are holding up the best. And it's subtle, but the fact that this stock is not making a new low and the relative strength line is showing you some strength, it's definitely something you want to have on your watch list, because these types of stocks, and there's a good 10, 12, 13 of these stocks that are not making new lows with the NASDAQ, which could really be those, was it beach balls underwater that could be the first to recover.
Yeah, that does look good.
So that's just a little bit of detail on the charts. So just to try to wrap this up, we've covered some good ground. As we mentioned, the midpoint is very, very important to help you frame up what's going on in the chart, accumulation versus distribution. We talked about stocks that, if the stock can't really recover and it starts to drift around underneath the midpoint, at a minimum, the stock has lost some momentum. It's slowed down a little bit. It might base, it might go sideways, or even worse, if a big institution starts to follow through with selling to the downside, more distribution could be around the corner. And that's one reason to be very, very cautious when you see a 3-bar break, particularly off of new highs. So pay really close attention, even in a big leader. You might say, well, I'm in the big leader. It's just a bad day. Be very cautious off all-time highs. You want to really, really dig into the chart because it's possible that something may be changing. The trend might be changing, or maybe we're going to go into a deeper correction. And as I mentioned, the simple 50% recovery rule, that's to get an initial read within a couple of days on the action of the stock. Obviously, you've got to do some more homework on it. You want to look at the general market and other leaders to see if it's a group thing or if it's just your individual stock might be starting to give you some sell signals. Anything more you want to say here about the summarization on the 3-bar break, Jason?
No, that's good stuff. And again, it's a situation where you take notice and do you need to scale back or not? And these things can also be used for price points for controlling an option. So if you do have a big name that you've got a big gain in, and you get one of these situations and it's resisting that midpoint as it's coming back up, but you still want to hold, you can potentially use that midpoint to define a strike price on some options. So some puts. So you can maybe offset the pain a little bit that way. That's up to each speculator. I'm working on ways to use that on the 3-bar breaks to the downside and upside using options. So but yeah.
Yeah, at a minimum, when you're looking at charts now, hopefully these start to jump out at you when you're looking at your charts. If you use candles, they're important. They're important pieces of information. Jason, I want to thank you for joining us today. You can find Jason at tickermonkey.com. He's excellent. Any of those people out there that really want to know more about candlesticks and candlestick combinations, Steve Neeson is kind of the godfather on candlestick charts, at least in modern times. And he's got multiple books out there that are really excellent. So there are lots of other resources. I understand. I think, Jason, you started with these books, right?
Not the books. I actually started with an actual course that he gave to a trader friend in Chicago that I was privy to getting the materials. And so that's kind of how I started. And I just signed up for his emails and just really learned it from free emails that he was sending and just kind of took it on my own. Google's out there, folks. Use
Yeah,
it.
Google's out there.
You know?
Dig in, dig in. There's a lot of
Yeah.
material on candlesticks and combinations. And I
Sure.
hope everybody enjoyed this GMU extra on the 3-bar break. We'll see you all on the next episode.